Hello, check. Hello. Hello, check.
Congress on role of higher educational institutions in SDGs, jointly organized by Internal Quality Assurance Cell, IQAC, and Career Development Center, CDC. I welcome you all for session 6 on sustainable financial analysis. Prayer is the key of the day that unlocks the door of joy and pushes the grief away. Now let's raise for prayer song. Thank you all. Now let's take a look on the SDG video. words of Neil Patel, a great video is one that inspires, educates, entertains, and most importantly, leaves a lasting impression on the viewer. Now it's time to look at a short AV about our respected chief guest.
Dr. S. Y.D. Subramaniam, currently he is the Vice Chancellor of Shastra Deemed University, Tanjavur and Tata Sons and Chair Professor of Management. He passed high schools from the prestigious portal from Padma Sheshatri Bala Bhavan Senior Secondary School, Madras with distinction. Bachelor of Electronics and Instrumentation Engineering from 1992 to 1996 from Bharatidasan University, Trichy, Tamil Nadu. Master of Business Administration MBA from 1998 to 2000 at Asian Institute of Management, Manila, Philippines, and Doctor of Philosophy from 2004 to 2009 from Shastra Deemed University and course completed as Visiting Scholar in University of Virginia, USA. Currently he is the Vice Chancellor of Shastra Deemed University and Chair Professor of Management. He worked as a regional sales executive at Johnson & Johnson Limited, Madras from June 2000 to August 2001. He worked as executive projects in Siemens Limited, Madras from June 1996 to April 1998 and worked as project consultant at Merlaco, Manila, Philippines from September 1999 to February 2000. He got many publications in reputed international journals to his credits. Placed in the Dean's Merit List during MBA study at Asian Institute of Management. Management Research Report titled Strategic Plan for Merlaco is Deregulated Environment was awarded distinction grade with high commendation. Prepared a detailed report on unique value strategy of implementing SAP from Siemens Limited, Chennai. Prepared a market research report for Haagen Dazs on the ice cream market in Manila. Prepared a marketing plans for private UPS manufacturing company in Manila. Prepared an HR compensation satisfaction report for a private telecom company in Manila. KPR College of Art, Science and Research is an immense pleasure to have such an eminent personality with us today. So ladies and gentlemen, let's put our hands together to welcome Dr. S. Y.D. Subramaniam.
Now I request the dignitaries to occupy the stage. Welcoming is a heartfelt emotion that expresses one's language of warmth, hospitality, and kindness. Now I may invite Aishwarya S. of First BCom PA to welcome the gathering.
Good morning to every one of you present here. It gives me an immense pleasure to start this auspicious occasion by heartily welcoming the esteemed icons on the dais, off the dais, and everyone gathered here. On behalf of Internal Quality Assurance Cell, IQAC, and Career Development Center, CDC, I welcome you all for the National Level Congress on Role of Higher Educational Institutions in SDGs. The fragrance of flowers spread only in the direction of the wind, but the goodness of a person spreads in all directions. Amidst us, we have such an inspiring personality, Dr. S. Y.D. Subramaniam, Vice Chancellor, Shastra Deemed University, Tanjavur. We welcome you, sir. With a thankful heart, I welcome Dr. P. Geeta, Principal, KPR CAS, who has given endless care, guidance, and support. We welcome you, madam. I bestow my welcome to Dr. S. Balasamy, Chief Executive, KPR CAS, who stands as a pillar to foster national level Congress. We welcome you, sir. I also welcome coordinators, Dr. Prathipa, Head IQAC, and Mr. Anand Prabhu, Placement Officer, without whom this wouldn't have been possible. Welcome you, sir and madam. It's also my great delight in welcoming Dean of Commerce, Dean of Computing Science, heads of various departments, members of faculty, and my friends for this session on sustainable financial analysis. Thank you.
Thank you, Aishwarya, for your warm welcome. Honor is the highest form of respect that recognizes one's dignity and token of achievement. Now I request Dr. S. Balasamy, CE KPR CAS, to honor our chief guest with a shawl. Followed by Dr. P. Geeta, Principal, KPR CAS, to honor with shield and memento. Thank you, dignitaries. Leader is the one who brings his value of presence and experience by his powerful speech of excellence. I'm so proud to invite Dr. S. Vaidya Subramaniam, Vice Chancellor, Shastra Deemed University, Thanjavur, to take over the session.
sounding.
B.
Hello, check.
B then.
What was the name of the bank? That's okay. One part is right. Silicon Valley Bank. What happened? என்னமா am I audible?
Sir, live.
லைவா முன்னாடியே சொல்லியிருக்கலாமே. Are you recording it? Okay, then I have to be a little careful, okay? Yeah, Silicon Valley Bank. What actually happened? You're right, it went insolvent. So why do firms go insolvent? Okay, so if you just pick one word from the topic that's given, why do firms go insolvent? Because they cannot afford, they don't have a model that can make them sustainable for a long period of time, right? So they, in this case, the Silicon Valley Bank went insolvent. Well, I don't want to go into the details of what happened to the bank, but do you know what the bank was actually doing? What was the purpose of the Silicon Valley Bank? They were? Okay, their business was related to the startup ecosystem. So it's like a bank for startups, right? What's your view on a large institution, especially a banking system, exposing themselves to only one type of a business ecosystem? Can a bank afford to stay focused only with one type of a business ecosystem? Yes or no? No. Why? What's the role of a bank? What's the role of a bank? This is your 2-mark question in your first semester, or even in 12th standard, right? Banks. So they collect money from depositors, savers, and then disburse it to those who require the money, right? So if that's the role of the bank, why do you say, what's wrong? I say I'm a specialist in financing startups. So what's wrong in that? What's wrong?
More risk.
More?
Risk.
More risk. For whom?
Bankers.
For the bank. Why?
We are only in one particular field.
Okay, so that again, they have taught you in your 101 course, don't put all the eggs in the same basket, diversify your portfolio and all of that. So, when that is the fundamental lesson that individual learners are being given, more so it is for big banks. And that's why, you see banks having a larger role to play in shaping up a larger socio-economic infrastructure. And of course, there will be some banks who say that they are more focused towards certain lines of businesses. Nothing wrong in that, as long as their portfolio has some diversity in it. As against saying that only startups, or I am just going to do only in one line of business, then those gets exposed to the risks, as somebody mentioned, because an economic cycle has its own, it's a sinusoidal wave pattern, right? Sometimes it will do well, there is a big boom and then there is a bust. So it's a boom and a bust, and that's how economic cycles operate, right? So when talking about economic cycle, economic crisis and all of that, what are all the major economic or financial crises that you are aware of as students of commerce or economics or management? What are all the major things that you have seen historically happening to the economic ecosystem or the business ecosystem or financial markets, whatever be the type of crisis. Can you recall any one of those or more than one? Global 2009, 8, okay, fine. So what happened there? You're right. Lehman Brothers, so there was a global financial crisis, mortgage based, home loans went delinquent, so that's one. Then we have had enough, the world has seen enough. One recent is the SVB, the Silicon Valley Bank. Then these are all general knowledge questions, okay. Chuma exam, I cleared my exam, pass next semester, and the something you have to relate with a little bit of economic history or financial history of institutions. You all know this World Bank, IMF and all of that. They're all development institutions, right? Development banks. Now, give me one or more such financial crisis. What happened in the early 2000? Early 2000. Now we are all using all these digital economy and all of that, right? But what happened in 2000? No, Y2K was a software, I mean technology, this thing. 2000 was your dot-com crisis, okay? All the equity markets, the stock markets were so inflated because of the boom in the dot-com space, e-commerce space. But that there again it saw its a bust happening and the markets actually fell miserably low because of the dot-com crisis. And a little before that, close to the Asian neighbors in the the late 90s, 97, 98, you had the East Asian economic crisis where it was more an Asian crisis. And then 2008, as she rightly said, you had the financial crisis that hit the globe. Then you still have the latest one, but before that you had the pandemic and then the Ukraine war. Then you had the the Iraq war in the early 90s that triggered the oil crisis. So, you know, the world is so interconnected that today a crisis that happens elsewhere will directly affect different geographies in different parts of the world. So it's not that, you know, a bank somewhere in North America went bust and we are safe. Well, we are more resilient and hence we don't feel the impact of that, but there are many Indian startups who also had some exposure to the Silicon Valley Bank, and hence the issue of sustainability is very, very important given the fact that the world in which we are operating today is so interconnected, not just financially, it's also by way of market reach. Your entire supply chain management is globally integrated. So any crisis happening anywhere is no longer a crisis that needs to be seen in isolation. It affects different stakeholders in different parts of the world. Now, this is a very, very broad, generic understanding of an institutional crisis that affects different institutions in different countries, and maybe in some cases the countries themselves. Okay, you saw, you know, your neighborhood, you're seeing how Pakistan as a country is really suffering. You saw Sri Lanka going through one of its worst phases, and right now being helped by various multilateral institutions that they are just beginning to look up. So different countries have also suffered the brunt of such huge crisis. So the issue of sustainability is not just, you know, of course it is important about the carbon footprint, the environment, the energy, food, hygiene, health. Yes, it is very, very important, but there is also a common thread, if not common, but at least economy and finance are supposed to be very strong, influential dimensions that affect almost all of the sustainable development goals, and there is some specific reference to that also in one of those 17 goals. But how can we now create or rather make you understand that apart from what I just said as global institutional sustainability, there is also something as students of commerce and management, you have to realize that when you work for a given organization, there is also something called an organization sustainability. At the end of the day, the survival of any organization, the survival of any corporate or any entity that functions as a going concern depends on the extent to which it has financial resources, because nothing is available for free. Okay? And when it is finance, what is the fundamental unit that actually measures the performance of organizations? It's the extent to which you have financial resources, which is expressed as the quantum of money, right? So money is, or currency or money, that is the fundamental unit of the economic engine, right? Now, if I have to measure the success of institutions through this fundamental unit of economic or financial success, how do I measure? Now, your accounting, your classes would have taught you how institutions prepare their financial statements, debit, credit, that, this, dual entry and all of that. So, I am not going to ask you any of those, but you know that every organization has a financial statement, and when you look at that, you will know how healthy or how weak an organization is. Yes or no? Right? So, have you heard of financial statements as second and third year students? So, what are all the financial statements? Balance sheet, profit and loss. Huh? Okay, then cash flow statement. So, these three main: balance sheet, P&L or income statement, and statement of cash flow, right? Then after you do all of that, then finally your faculty would have told you, well, this is all there, but finally you know that part C question, 25 marks, 30 marks, whatever it is, there is something called this ratio analysis. They have told you this ratio, that ratio and all of that, right? What are all the ratios that they told you? Huh? Okay. Profitability ratio, huh? Okay. Solvency, liquidity, capital gearing. Oh, I have not heard of. What is that actually? Capital gearing ratio. What is it?
The combination of internal equity as well as external debt.
Oh, capital structure.
Capital structure.
Okay. But what is it? Why is it capital gearing? Can you spell it? But why capital gearing? Why? What's the? Huh? Bookla அப்படிதான் இருக்கு சார்.
Long term fixed interest or dividend bearing funds divided by shareholders funds.
Yeah, I got it, but I'm just curious to know why it's called capital gearing ratio. This is the first time I'm hearing that. That's fine. So that's your capital structure, right? Okay, then turnover ratio. Then, Adaba capital structure. Capital structure. See, from now on, another thing is, I always tell my students that one part of your learning is to what? It's a knowledge, adala philosophy, that's all right. Let's get to practical. One part of your learning is for what? Pass exam. Correct. Practical correct, badil, right? So for this lecture, we will raise the thought process. Okay. So debt equity ratio is right. And then tomorrow interview. See, sometimes in an interview, when somebody asks you a question, okay, you might not know the correct answer. But then if you can give it back by using something that people think is an advanced term, which even the interviewer will not know, sometimes you can get away also. They will think, oh, you know more than the interviewer, right? So, andamari terms we will start using, okay. So, capital structure means it covers debt equity ratio and all of that. So, next time we just use the word capital structure. Now, debt equity in poitan, then that fellow will ask you, oh, debt, what long term, short term, then other what this debt, that debt, equity, this equity, that equity. So, capital structure na avarike konja yosipar. Oh, capital structure, he has heard it somewhere, but that's the right answer. But anyway, let's come back. So, these are some of the major ratios, right? But then, did we miss any important ratio? Finally, your faculty would have told you, all this ratio we will put into one. If there is one ratio that can summarize all of this, what ratio is that? No, not working capital. Working capital comes somewhere in your liquidity. One big motherhood ratio that will, consume all of this. Faculty, you சொல்லி கொடுத்தீங்களா இல்லையா சொல்லி கொடுக்கல syllabusல இல்ல. There is something called DuPont ratio. Have you heard of it? DuPont. சொல்லி கொடுக்கலையா? Okay. So DuPont ratio, right? Why DuPont ratio? DuPont, what's DuPont? DuPont, what's DuPont? General knowledge. DuPont is the name of it's the name of a firm. Okay, it's a North American headquartered corporation. DuPont is the organization that actually used that ratio to do its financial analysis, to understand how stable, sustainable that the organization is by looking at a set of three important ratios that will cover almost all of the ratios, right? Now, how many of you have seen the annual report of companies? When you look at balance sheet, P&L, cash flow statement and all of that, you said, finally all of that is presented in a company's annual report, right? An annual report is presented every financial year. Have you seen an annual report? Yes, sir. So what have you seen in an annual report? What have you seen? What have you seen in an annual report? Huh? Which company's annual report you have seen? Huh? It will have balance sheet, it will have P&L, it will have all the other trading account. It will have cash flow statement, then some important comparison statements year on year, key ratios, then board members, who are all the meetings they have attended, some major resolutions, some all of those that require compliance, all those reports. Today there is something called the ESDG compliance, and that's got something to do with your SDGs also. Then but it all starts with what? In an annual report, the first few pages. In an annual general body meeting of shareholders, who talks? The chairman or the CEO speaks, right? And he traces the organization's performance in the previous year. And generally, you would have seen those people saying that the fundamental purpose of this organization is to maximize dash, maximize profit, no, then maximize wealth, okay, maximize wealth, then whose wealth? Shareholders' wealth, okay, company's wealth. I'll come to that, okay. Shareholders' wealth, let's pick that. That's the closest to the right answer, right? But that used to be the opening remark if it were like 10 years, 15 years back, right? Today, again, the fundamental objective of the organization is to maximize dash wealth. Shareholder gets replaced by stakeholder, right? What's the difference between both?
Stakeholders are internal and external members related to an organization.
Example.
Like their customers, suppliers, employees.
Then shareholders?
Shareholders are investors.
Investors, owners of the firm, part owners of the firm. So what do you understand? Why this shift from shareholders' wealth to stakeholder? Abba, answer panten. Next time when I keka mattaru. What is the difference between shareholder versus stakeholder? What's the difference? Why the sudden drift from shareholders' wealth to stakeholders' wealth? Because there is more and more consciousness amongst organizations that it is not just maximizing shareholder wealth that's the fundamental objective of an organization. It also includes a stakeholder wealth, as she said, internal, external. It could be your suppliers, vendors, customers, civil societies, employees, the surrounding ecosystem, and all of that. And that's in essence what your SDG also talks about. Relate yourself with some external stakeholders so that you add some incremental value in enriching the resource base of each of those external stakeholders, right? But then again, on the other hand, your business school, the business instinct also tells you, well, that is also right, but at the same time, if an organization has to exist, then it has to make money, and then it has to be aggressive in the market space, and only then it can become profitable, and only if I become profitable will I be able to satisfy, the external stakeholder demands. So it's a catch-22 where you have to be mindful of certain obligations that you have to discharge to other stakeholders, and at the same time you should also be able to do well in the line of business that you operate. Now, how do we create a balance between both? Well, the first thing is, the bottom line is that you have to do well in your business, and you'll have to be financially strong. So financial robustness is necessary for any organization, right? Now, why did I say all of this? Say you started off with DuPont and you're going elsewhere. No. Now, what does your DuPont ratio look like? By now, somebody I thought would have Googled and given me the answer, DuPont ratio. What is DuPont ratio? Feel free to just go to the internet, and if you have, just let me know or if there is a ban not using it, then forget about it. We will start. So what's DuPont? You want to do that? Yeah, please. It's better it comes from you. So what does it measure? What does it measure? நீங்கள் faculty, students answer பண்ணிட்டோம். We will have one separate faculty round at the end of this session, whatever questions you want. Yeah, come on, quick. No internet, huh? Okay, then let's not waste time. So, at least what does it measure? You said the first thing is the objective of an organization is to maximize stakeholders' wealth is the qualitative part, but let's stick to the quantitative part, which is the shareholders' wealth. So, what is proxy to shareholders' wealth? What measures shareholders' wealth? Money. So, return on what measures profit of an organization? Net profit. So, what measures profit for a shareholder? Dividend. So, that's all measured by a percentage. Okay, I mean it's a return on, right? But who is the investor here? Shareholder. So, it's a return on equity. Return on, okay. So, what is return on equity as a ratio? What's return on equity? What's return on equity? Profit of shareholder. How do you measure that? How do you measure that? How do you measure that? How much of the net income that the firm generates, that goes to the shareholders, right? So, what's the numerator? So, use the word profit is very general. It's gross profit or operating profit or net profit. So, shall I say net income or net profit? It's all the same, and divided by total shareholders' equity, right? Okay. Now, if this were this simple, then why all this big significance and drama to this DuPont ratio? So, the DuPont ratio, what it tries to do is to see whether I can unbundle this ratio into a set of 3 different ratios. And how do I do that? For your return on equity to be maximum, what else can contribute to a maximizing return on equity? First thing you said in your ratio analysis, what was the first ratio you said? Profitability ratio. So, how do you measure profitability? Huh? What's profitability? Come on, somebody is answering, but the moment I look at this side, you are silent. If it's a wrong answer also fine, you answer, that's important. Net income? Net income by? Sales, right. That's what? What is that? Profitability. Okay. Now, suppose I tell you that a DuPont ratio can be expressed as a product of three ratios. Understand what I am saying? That a DuPont ratio can be expressed as a product of three ratios. Can this ratio be expressed as a product of three other ratios, one of which I have already written? Yes, right? So mathematically what I am trying to say is A by D. A by D. A by D is equal to A by D is equal to A by D cannot be B by C. No. A by D, if you have to express as a product of three ratios, then A by D is equal to A by B into B by C into C by D. So your third standard, fourth standard mathematics teacher would have told you, oh, B cancel panni, C cancel panni, then it becomes A by D. So your A by D is A by B into B by C into C by D, right? So your net profitability is, return on equity is, one I have already given, profitability. Net income by sales. So automatically what should be in the next ratio numerator? Sales. But what should be the ratio? What should be the ratio? Now we have to think a little big. You are measuring the stability of an organization, the sustainability of an organization. One important metric that measures the sustainability is how the extent to which it is profitable, right? Then think of another large financial metric that has significant importance on the firm's sustainability. And we are only talking about financial sustainability. Any other large important metric? Huh? Good, you're almost there. So, okay, production. So, how do you produce? Huh? How do you produce? Operating expenses is you incur expenses, okay. You incur expenses on what? Assets, okay. No, who said assets? Assets. Okay, I'll ask you the question. Assets, what is asset? Huh? Machinery is one form of an asset. Land and building is, these are all types of assets. Okay? Any economic resource that creates revenue for the firm is an asset. Right? Whether it's a capital asset or not capital asset, that's all fine, but anything that has some economic value which is used to generate revenue is an asset, right? Now, since you've said assets, why is that very important? Anybody can answer. I am shifting my eyes now. Why is assets important? As much as everybody agrees sales is important, right? And only if you know how good your sales is, how profitable your sales is, and that's why we started with net income, which means you are making profitable sales. There is no point in just recording sales. In our P&L, there is something called top line. What is top line? What is top line of your income statement, your P&L statement? What is top line? What is top line? Profit. Huh? Profit, first thing in your P&L, what is it? No, first item in your P&L. Capital? No. First thing. Oh, you're complicating it. First thing you write only sales, right? Revenue, sales. That's your top line. See, you will have to familiarize yourself with these terminologies, okay? Now, like interview, if you go and sit there, if somebody says, what's the top line means? Top line, enak theriyadhu sir. Top line is sales. What is bottom line? Net profit. The bottom line is net profit. Then there is something, this middle is all your cost of goods sold, operating expenses and all of that, right? Now, how do you know that you are making good sales? Net income by sales. The next important thing that you identified is asset, right? Why is that important? As much as you use your profitability ratio to understand whether your sales is actually generating enough profits, what would you like your assets to do? Generate? But how do you measure the effectiveness with which your assets generate revenue? Somebody said that term somewhere. I heard it. You will have to be bold and answer it. No, somebody said something. Oh, mask, okay. What is turnover ratio? Any total sales? Suppose I say it's asset turnover ratio. What do I mean? Turnover from asset. What does it mean? Students. Turnover ratio, asset turnover. I've almost given you the answer. Now it's only general knowledge. Usage. How effectively we the assets, right? After all, what is your asset? Look at your balance sheet. No, that's the very beautiful part of finance is everything is linked somehow. What is your balance sheet? What equals to what? Right. So assets equal to liabilities. So suppose I say this is asset, then there is something called liability. Right? Now, if I have assets and you know that you've got the assets through liability, can you afford to have your assets idle? So you cannot have your assets to idle because it has on the other side a liability fellow who will keep on asking assets, what are you doing, you owe me money, whether it's bank or whether shareholders or whoever it is. Asset has to be answerable to the liability. Now, how do you ensure that the asset is answerable to the liability? You will have to start using it effectively, and that's your asset turnover ratio, how quickly you are churning your assets so that it generates sales for it to make revenue, right? So that's your asset turnover ratio. The more and more you do it effectively, because asset represents locked capital. If you spend $1 billion and buy land, equipment, machinery, it means that capital is locked, right? And I have to use that effectively for me to ensure that the capital that is deployed is used properly, right? So what is your second ratio then? I've already written. So what should it be? Sales. Now there is this last ratio. Okay, I told you it's a product of 3 ratios. We have written 2 in the last. First one total assets, that's clear mathematics, 4th standard passed. Then in fact answer irke inge vera idu vera irke equity irukku already, so it is total equity or shareholder equity alla onnu da, right? But why is that important? Sales, net profit by sales is important because you need to know whether your sales is healthy, whether you are doing profitable sales. Then the second asset, that's important because then you are answerable to your management, your leadership on the effective use of the assets, right? Then the third ratio is what? Now somebody tell me, why is that important? Maybe third year students and second year students if possible. Why is that important? Some just think, no, chinna oru common sense question. Why is that important? Again, what is the balance sheet? Assets equal to liabilities. So where did you get your assets from? Liabilities. What are all the major source of liabilities? Huh? Equity and where do you get your assets from? From the liability side. What contributes to the liability? Your capital, which is your equity capital or debt capital, right? Now tell me, third ratio.
Shareholders invested in the assets, so we are calculating the amount which we earn from the shareholders fund.
Shareholders?
Fund.
No, but what is the ratio there? Total assets by? So is there any sales there? Sales irukadala, so return kadiyadu, right? Total assets by equity. Why is that important? You already told the answer, you just have to relate it with the ratio. You only told me that assets equal to liabilities, and what constitutes liability? Debt capital and equity capital. And what is your ratio? What is the ratio here? Asset by equity. Now who said debt equity ratio? Right. Now why is that ratio important? So what term you should use? I told you before. Capital structure. So this one will tell you the extent or the importance of capital structure of a firm. For the assets that you have, how much came from debt, how much came from equity, right? Now why is that important? Of course, this is something that you would not have been taught as undergraduate students, but you should know this, okay? Now why is that capital structure important? Think, who's the topper in the class? Mark vaangiravanga intelligent kedaidu, adhu sollirudha, adnala don't worry about that. So let me withdraw the question, okay? Topper la illa, somebody who can think. Why is capital structure important? Why is capital structure important? Okay, before going there, I'll ask you another small sub question. Just like capital structure is debt equity, right? There is something called, see, capital structure is the measure of your financial leverage, right? Whereas there is something called operating leverage. What is operating leverage? And that is very important for this ratio. What is operating leverage? Suppose you have a lot of fixed assets, right? Let's say your firm, you have a lot of fixed assets, and I told you that you have to use assets productively, right? Now what is the challenge that firms that are, they call themselves as capitally intensive, which means a lot of fixed assets. So capital intensive firms have to achieve scale economies. Okay, these are all some terminologies that you should start using. Scale economies. What do you mean by scale economy? ஒண்ணு பண்ணா போறாது. You have to make thousands, millions. Why? Only if there is scale, your fixed cost gets distributed to more unit products, right? So that is why the more and more your fixed cost is, the more and more you have to achieve scale in economy, which you will read. I think you should have read, no? Fixed cost, variable cost. So that's the essence of the scale economy. Now coming back, as much as operational leverage has got something to do with scale economies because of the fixed cost, what is financial leverage? Financial leverage is your capital structure. Now why is that important? Why is that important?
Because that is it seems to be an important indicator as how the organization is resilient towards some disaster. It seems to be a KPI.
Why is it important?
It directly talks about earnings available for equity shareholders.
Extent of borrowing. Extent of borrowing, I can see my balance sheet. There will be liabilities, I can find it out. So that's quantum, okay? You are right, but why is it important? Okay, I know this is the borrowing. Then
Talks about financial capacity of the firm in repaying the debts.
that I can calculate by using your liquidity ratio times interest earned ratio. So what is EBIT? Earnings before interest and tax. All clear. But coming back to the question, there is no free lunch, right? There is no free lunch. Capital is not given free, right? So there is something that has a cost to it, right? And what is your source of capital, as you rightly mentioned now? Equity and debt. Let's not go into the type of debts, debentures, bonds, long-term debts, and all of that. There's broadly debt, and then equity. Is it available free? We'll go one by one. Is it available free? No. Then it's available for a cost. What is cost of debt?
Interest divided by total debt.
Interest. Cost of debt is the interest. What is cost of equity? Dividend. Yaar sonna? Dividend, right? So I'll just go a little bit ahead, but I'll come back to this. Just want to test how much you have understood the concept of dividends or shares, right? Today you put your money in a bank, right? And the UPI, all these interfaces that you are using, right? Google Pay and all of that. What exactly happens? What happens? Transferring money from one account to another account, right? So essentially the money from your account gets to transfer to the receiver's account, right? So today you had something in a restaurant that costed you 200 rupees, right? And you did a Google Pay and it went to Annapurna's account. How much? 200. But the 200 that you transferred is the same 200 that fellow got. The value of that is same, Now, tomorrow, just for the sake of argument, we will say there is no need to transfer money, but we will resort to the old barter system, that you transfer one stock that you own at this value to the other fellow. Why not? What change? Stock value? It may change. Good. So what do you mean by value of stock? What do you mean by that? So you read in the newspaper, right? Sensex went up, this thing went up and all of that. What does it mean actually?
The value of stocks will change.
Value of the stock change, right? But what is your understanding? I am sure you would not have covered this in your syllabus, but then it's better to know just the basics of that. What do you mean by value of a stock? Or forget about stock. What do you mean by value of an asset? Stock is just one of those underlying assets. Value of the stock, value of the house, value of the land, value of the building, value of the firm, anything, right? Say you had 1 crore and you purchased land in Coimbatore, let's say Sai Baba colony, the premium property land inge Coimbatore, that's supposed to be very expensive real estate, right? 10 years back you got a land that was worth 1 crore, right? Now 10 years later you want to buy same amount of land in that area. How much will you pay? How much will you pay? This got nothing to do with what I am saying, but then I just want to understand whether you have conceptually understood what I am trying to say. How much will you end up paying? Some value more than 1 crore definitely. 2 crores, 3 crores, 4 crores. Immediately what will you say? Value of the? No, I don't want to go into time value. Have you been taught that? Time value of money? No, right? Yes, sir. Anavasima, don't get into trouble. Okay. Value of land has not gone up. The purchasing power of the has come down. Land is same value, but we have colloquially said value of the land has gone up. Actually, the purchasing power of the currency has come down, right? So, I told you I am just going one step ahead, but let me come back to the conversation here. So, the value of any asset, as somebody said, since you've already been taught time value of money, the value of any asset is the present value of the future cash flows that the asset can bring to it, right? So, what is the value of the stock? What is the value of the stock? Present value of the value of an asset is the net present value of the future cash flows that the asset can bring, right? In your first accounting class, they would have told you, first accounting principle, going concern, that this firm will always exist for an infinite period of time. So, an asset will generate income, cash over an infinite period of time, and the value of that asset is the net present value of the future cash that it is going to generate forever. That's the value of the asset, right? Now I am just replacing the word asset by stock. So value of the stock is the net present value of dividend that it's going to keep on generate, because a stock will exist forever, right? When will you sell a stock? When will you sell a stock? I'll just stop with this interesting observation, then you will understand what I am trying to say. Okay, So let's say somebody has stock, right? Who wants to sell it? Hypothetical question, but just answer. Who wants to sell it? You want to sell it? Why do you want to sell it?
I have got it at this 10 means I can sell it at this 20.
So now you feel 20, its peak value, you want to sell, right? So you raise your hand. He wants to sell. Who wants to buy? Whom will you sell it to?
Someone who is needed for it.
Somebody has to buy that, right? So who wants to buy? Who wants to buy? Oh, that fellow at the back wants to buy. Why do you want to buy? Huh? Why? No, but that fellow just now said, it's 20, adhik mele pogadu sir, I want to sell. And you want to buy? So, a stock is not just like that, somebody is interested to sell, you don't sell it. For a particular investor who has only a specific appetite for investment, feels that that price of that stock has actually peaked out, so he is selling, but he can sell it to only another buyer who has a contrarian view that says, oh, there is still a lot of value that the stock can achieve, and so I am buying. Okay, so that's how stocks get traded. So the value of that stock is dependent on the net present value of the future dividends that it will generate. That's one way of valuing a stock, okay, that we called as the dividend growth model, and I am not going to get into that. But coming back to this, so the value of the equity that is here is the value of all the stocks of the firm, right? Now, if it is assets by equity, then you should know how much of equity is required to finance your asset acquisition and how much could be from debt, right? It's not that someday somebody said 20% debt, 80% equity. Nothing is free. Debt also is interest. Stock, oh, that's why we went to stock this much. The cost of equity is your dividend. So we went to cover all of that only to tell you the fact that the cost of equity is your dividend. So that's also not free. You might decide not to give dividend. That's a different issue, but that doesn't mean that it's freely available equity, right? You are only postponing your dividend payments for a future period, and if you don't pay dividends, then automatically investors will pull out, right? So your equity base will start reducing. Okay, so you cannot be a sustainable capital structure excessively dependent on debt or excessively dependent on equity. There must be a balance between debt and equity. And when will you achieve that balance? When your capital structure is, we call that in finance optimum capital structure, which means optimum level of debt and optimum level of equity. You would not have been taught about that, but at least it's good to know that debt equity structure means that there must be some optimum level of debt and optimum level of equity. Now, when do I know that my capital structure is optimum? There are three things that you will notice. At optimum capital structure, the value of the firm is maximum, and then the value of the value of the equity is also maximum. Then, okay, but have you been taught about that? Oh, you are? Okay. Third year students, raise your hand. Second year solli kodutringilla, then there are second year students also, no? So we don't call it as cost of capital. What do you call it as? What do you call it as?
Weighted average cost of capital.
Students, what do you call it as? WACC, right? Weighted average cost of capital. Why is it called the weighted average cost of capital?
It's the overall cost of capital.
No, but why is it called weighted average cost of capital? Because of what? You should answer. It's there in the acronym itself. WACC means what? Weighted average cost of capital. What is a weight? What does that weight symbolize? What is the significance of the weight? How much of? Oh, passing answer panto. How much of? Weight of debt and weight of equity. Now, if weight of debt and weight of equity determines your weighted average cost of capital, your weighted average cost of capital has to be minimum at the optimum capital structure. So, the capital structure at which your weighted average cost of capital is minimum is your optimum capital structure. And at optimum capital structure, the value of the firm is maximum. So, at optimum capital structure, this ratio makes a lot of sense because you are not using excess equity nor are you using less equity, you are using right levels of equity. Now, if I need to understand all the three put together, I told you in the beginning that institutional stability, regulatory stability, institutional sustainability, regulatory sustainability, that's one part. And then at an organization level, you should be concerned about organization's sustainability, which predominantly, since everybody respects money, it has to be understood from a financial perspective. And to understand the sustainability of finance, immediately we relate to return on equity, because that's the larger objective of any organization, is to first ensure that the shareholders' wealth is maximized. And of course, that term is now getting replaced with stakeholders, but shareholders form the dominant part of a stakeholder community. So, we are concerned about the return on equity, and the return on equity is unbundled into three ratios, each of which has its own contribution to the sustainability of the firm. The first one, how profitable your business is. Otherwise, your businesses don't exist. Nobody is a fool to run a loss-making enterprise. So, to be a sustainable enterprise, you have to first start making money, and that's measured by your profitability ratio. And then, for your assets to be used to its maximum, you will have to ensure that they are also sustainable and it is used efficiently to ensure its sustainability. And lastly, to maximize the value of the firm, because today firms are respected for the value that it is being measured. I can always show good sales, good net profit, but still low value, right? But that's a different ball game altogether. That's valuation, which is highly sophisticated in finance, but they have to generate value, and that will be maximized if you have right levels of debt and equity in your capital structure. So, if I were to, in a very my own way, and this is not according to any syllabus book, okay? So, tomorrow don't ask me, sir, where is this, that I have never heard of anything called financial stability. This is something that, you can also have your own models of financial stability. You can come out with different sets of ratios and say, this is what I think is about financial sustainability. You are right also, because you are looking at sustainability from a different perspective, right? Your principal called me and it was about sustainability, and since I don't know really much about environmental and other forms of sustainability, I am a management and a finance guy. So, I said, okay, I will talk about financial sustainability, and I just chose this model to just tell you that sustainability stems from various sources, but I am more interested in these three ratios. And if you agree with me, then you can also start looking at annual reports of firms, look at their financial statements, do a DuPont analysis to see whether there is healthy sales, whether there is maximum use of assets, and whether the capital structure is leveraged properly with good mix of debt and equity. And if a firm does all the three, then definitely I can safely conclude that yes, it is financially sustainable because its trajectory is in the right direction, because all these three ratios are of very high sustainable order. Okay? So thank you, and I can take some questions if you have. Questions from both faculty and students, I don't mind. Any questions, or if you don't have questions also, we can say bye. How many of you want to study MBA after this? Kai thooku. MBA, only one? 2, 3, 4, okay, some hands are popping up. Okay, fine. Come on, questions? Any questions?
So what are the key factors to be considered before investing in a company?
What are
the key factors to be considered before investing in a company?
Okay. So, as an equity investor, okay, so you'll have to first, as I said, look at whether the current value of the stock is actually correct. So, when will you invest? When you find that the current valuation is actually lower than its potential value. So, if you are able to make a valuation and find that the net present value of the stock is actually more than the price at which it's getting traded, you immediately buy the stock. That's from a financial perspective. The other part is if you are a risk-taking investor. You say, I have some of my portfolio already in debt, so that's safe investments. I would like to take extra risk and get more returns. So it's as a policy that you want more returns, you are an aggressive investor with more risk appetite, then you decide to invest in stocks. So that's one reason why you go to stocks. Did I answer your question? Mic went somewhere at the back. Any student who wants to ask? அப்போ நான் மைக்கை திருப்பி கொடுத்துரு எடுத்துன்னு விடாது மைக் எங்கெங்கேயோ போச்சு. Okay, so I'll assume no questions from faculty.
Apart from subject, what are all the success mantras of Shastra?
Okay, I'll come to that. You had a...
No, it is in line with what sir was asking. I was about to ask, give us some few tips as how educational institutions can ensure this ROE at the optimum.
Yeah, so that's what. So this ultimately I'll have to tie it to your faculty, your curriculum. When you teach something, don't teach because it's in the syllabus and you have a standard set of question paper. The Bharatiya University says 2 into 5, 10 marks, 5 into 3, 15 marks. That's for exam, right? I always say this, a degree is not a certificate to leave campus. It's a certificate to enter career, right? So as faculty, you will have to make sure that you are not preparing students to just get a degree and leave the campus. They have to get a degree to enter, a certificate to enter their life. Now, only if you teach like this, there is some value addition to the exercise that you are doing. Also, as education institutions, today the word SDG, the Sustainable Development Goals, is so sweepingly applicable that any subject, any syllabus, anything you can link with SDG, because that's the bandwidth with which the SDG is operating. That's the expansiveness of the broad agenda that SDG has. So in fact, I was wondering, how so many topics, everybody is going to talk about this, how are they going to link? Maybe sustainability is one, I'm not saying easy, but an idea which is as expansive as it can get, that all subjects can be linked to that. So today there is another parallel narrative that is also happening, that is called the Indian knowledge systems. Today there is a push amongst institutions to see how much each of your subject, you can also build an IKS component into that. So you will have to also consciously take a decision to each of the subject I am teaching, how much can we embed SDG component into that. Then you will knowingly or unknowingly be able to bring one small element. It can be incremental. It need not be very transformational. Some incremental value by consciously thinking that it has to be linked with SDG. Then it's easy to do that.
That is at the curriculum level. I'm asking you about the management level. What best practices you can suggest for an higher education institute to ensure that the ROE is aligned?
So I will as a management, I will ensure that my curriculum first gets aligned to this. Then my faculty has expertise and I build capacity amongst the faculty, and then the faculty is also able to relay that and translate that to the student. And then as you become autonomous or universities, you will assess the students so that they achieve that type of a learning outcome from an SDG perspective. Now you are constrained because you have only one university question paper and all of that, but then I think some limited autonomy that you have that you can exercise, try to use that autonomy and try to build that. So that's the role of leadership, to ensure that within the limited autonomy whatever you have, you make sure that this happens. Okay, no questions?
What are the best practices you found in foreign universities and top universities in India compared to the mediocre institutes in teaching and learning process? The same syllabus we read here and also in IIM. So what makes IIMs and other big universities different from us?
Well, actually, I don't know whether you have read my articles. Of course, IIM is a very good institution. I greatly respect that, but I also feel that there are other institutions that are also doing a good job, except that they don't brand themselves or position themselves as IIMs. And I always subscribe to one theory that the society itself is like an open air university. So there are many people who, without formal education, are actually doing well. So IIM is just that icing on the cake. But and I call them the MBAs that come out of this. Is recorded, right? We can stop that now. Either stop, recording is over. So formal is all over, right?